We believe that the institutional behavior and moves recently have been fascinating. We have been expecting institutions to start moving into Bitcoin and other crypto assets, but primarily Bitcoin, the most secure of the blockchains, because if you look at the correlation of Bitcoin's performance relative to any other asset class, it has the lowest correlation, meaning if you buy some Bitcoin, you will further diversify your portfolio and increase your returns with lower risk, right? So that's why institutions look for that low correlation. Bitcoin has it. And so that's clear. We have 10 years of history now. But what surprised me and us generally was to watch MicroStrategy, which has put all the cash on its balance sheet into Bitcoin, and even did another equity offering so it could put more cash on its balance sheet. And I think that's a little crazy, because I think the regulators will have something to say about this in terms of what is this? Is this company the MicroStrategy technology company, or is it like an ETF? So we don't know about that. But then you saw Square put 1% of all of its assets in Bitcoin. And I think you're going to see more of that. We didn't expect that. What we did expect was, because of the low correlation of returns, institutional investors to move in. The most surprising one to me thus far has been MassMutual. It put $100 million into its general account. Now, its general account is enormous. So $100 million is something like 0.001. But what that move told us is, MassMutual is very conservative and very highly regulated. And so it had to jump through many more regulatory hurdles than I thought would have been possible by now. So I think that is a seal of approval. And then, of course, you have the institutional infrastructure moving into place, whether it's with custody, and everyone knows a lot about Fidelity being out there in terms of wanting to custody Bitcoin in particular. You have the Intercontinental Exchange, and you've got the CME now with Bitcoin futures, one settling in kind, one settling in cash. And so we do believe that Bitcoin is getting ready for institutional. We have a very disciplined process. And so our minimum hurdle rate of return for a stock to enter the portfolio is 15% at a compound annual rate over 5 years. We expect the stocks in our portfolio to double over the next 5 years. Now, when you have big runs, as we did last year, a lot of stocks drop below that 15% as a 5-year expectation. And so when they drop into the 10 to 15%, we'll be taking profits. So we are selling, if they're core to our platforms, then we will probably sell, if we think it's gotten way out of hand, we'll sell it down to 50 basis points. We've gone from 10% to 50 basis points in stocks, and exiting some as well. Even if they are core, we just think, okay, they're going to need a long time to grow into this valuation, and we don't want to live with or sit with dead money. But then we will get corrections like the coronavirus, right? And what we do during a correction, we will have sold stocks that are core. For example, 2U and Teladoc are they were in both our next generation internet portfolio and our flagship before the coronavirus. Both of them benefited from stay at home. They started moving up as other of our stocks were crashing. They moved up to such a point, they dropped below the 15%, as these others were giving us opportunities to deliver 50% plus at a compound annual rate. That's at the beginning of last year. At the beginning of last year, that number, that 5-year number, was 42%. Today it's closer to 20%. But stock by stock, we're looking at that 15%. And the more it falls below, the more profits we will take. So we have such a creative research team, however, and there are so many stocks vying for our attention and with these IPOs, vying for a position in our portfolios that when a stock drops below 15%, we know there's something else waiting, knocking at our door, waiting to get in. Are we in a bubble? I do not believe so. And I am very happy that many people are worrying that we're in a bubble. I experienced the late 90s bubble, and yeah, the value investors out there were really worried, and they think they're going to have their day in the sun again because they did so well during the tech and telecom bust. I don't think that's the case now. I think that the seeds for what we're experiencing now were planted back then. Too much capital chased those opportunities too soon after too few opportunities. There were too few opportunities, and the technologies weren't right. The costs were way too high. We're at prime time for those 5 platforms now and those 14 technologies. And we've just begun, and they're going to be very disruptive and maybe destructive to a lot of value spaces. Not everyone, but anyone looking at price to book, watch out for that book. It may disappear because of disruptive innovation. Anyone looking at that high dividend yield saying, I got to hold on to the stock, be suspicious of high dividend yields if that company is in harm's way. And I would say there's about 50% of the S&P 500 in harm's way. Why don't we? I think we're in a bubble. Because if you look at equity flows since the beginning of 2018, and remember, we had a big market in 2017, so you'd have expected flows to really start to gush. What has happened since then is there's been net liquidation. If you just look at ETFs and mutual funds, there's been a liquidation to the tune of $350 billion if you take away share repurchases. Don't count those. But if you look at fixed income, there has been a net inflow of roughly $900 billion. So think about that, a $1.2 trillion gap there. I will not believe we are in a bubble, equities that is, until we see that relationship flip. I believe bonds are in a bubble, and I believe what just happened with GameStop and AMC and American Airlines, Bed Bath & Beyond, all of those, that is exacerbating the bond bubble because you're bailing those bondholders out so they can put money elsewhere. And so, you know, I find it a really interesting phenomenon. I don't think it'll last. I think it's been a good wake-up call for investors generally to, you know, understand who is doing what and why. And for investors like ARK to say, look, truth will win out. Make sure you're on the right side of change because there is so much disruption and destruction taking place out there, and it will take place at an accelerated rate during the next 5 to 10 years. So be careful. And, you know, we put out a parody. I don't know if you saw it. We put out a parody, and it was really, we were trying to make this point because we were having trouble communicating it to those who really believe that index funds are safe.